Ladies and gentlemen, I'm really pleased to introduce this seminar, market briefing with Kenneth Underhill. Kenneth actually has been around for a few years. He spent 16 years within the insurance, both at Heath Lambert and also as a senior board member of Icsr, and then he went over to RPC, but he's come back and he's here today to talk about this particular item, which is very, very important, as we know that pricing is a key issue for the FCA, and we need to be agile, and we also need to be very prepared about this. Kenneth will actually raise some of the issues that he's seeing, and he'll also hopefully outline some of the key actions that we as MGAs will be able to take. Ladies and gentlemen, please welcome Kenneth Underhill.
Thank you very much. I hope I'm able to live up to Peter's kind words. We're going to start with, there we go, we'll do a quick introduction, we'll look at some of the issues, what's next, and then what you can do now. And that's, for me, the important thing, because there is things that people should be thinking about now and doing now. There's a lot of work in here, and there's a lot of rhetoric, which I'll come across as we go through the presentation. But first, because this is a briefing and because some people need their continuing education points, we need to briefly cover off the learning objectives of today. So the first one is that we will identify deeper issues likely to be under consideration by the FCA. We'll understand, hopefully you'll understand, the likely timescales within which the FCA may take action or you should be required to act. And you'll develop a clear understanding of any key actions your firm can take. Okay? You can check all of that at the end if we wish. Right. Okay, so we're going to have a potted history and I'll cover off some of the points as we go through. I think everybody knows that the FCA, right from the get-go, focused on value. There was an awful lot of talk about value in the distribution chain, value in the products that were being provided. Along the way, shortly after the FCA came into existence, we saw some horror stories come out. There was something involving CPP. I don't know if any of you remember it. They had a product that they were selling for roughly £35. Of that £35, the net premium was £1. And of that £1, there was a 60 or 70% profit margin. So needless to say, CPP have moved on from those sort of days, but that was the sort of thing that was really a focus for the FCA in its early years. And then the genesis of where we are now with pricing, they're drilling down further beyond the distribution chain, because we already know that the wholesale review is still underway. That is completely separate to what they're doing here, but value in the chain remains an issue. Here, the genesis comes from, strangely enough, the greengrocing industry, supermarkets and the pricing of groceries. And the reason for that is that in 2015, Which issued a super complaint, one of the first super complaints, which really focused on pricing and pricing for consumers. It wasn't long after that there was a great deal of discussion about pricing in financial services. The FCA issued some documentation in 2016, and shortly afterwards we had new rules on increased transparency requirements for services and products. Then shortly after that, early in 2017, the FCA issues its 2017 business plan for that year and for last year. And that, at the top, they described it as specific discovery work on pricing practices. What that actually meant was a thematic review. Once it became a debate, there was an increase in focus on pricing. So we had, in April, the Financial Ombudsman issues a report on complaints within pricing, and I will come back to that because there are themes through that report which are now appearing and have been supported by the thematic review that the FCA has done. We also had an increase in the rhetoric. So there's a government green paper in April last year. and I'm going to quote from that because this is some extraordinary language from anybody, really. What the government Green Paper called for was a vigorous tackling of exploitation of loyal customers. That's a warning, that's the beginning of the rhetoric, and that's really a warning for everybody that the government is pushing this agenda as much as which, as much as Citizens Advice, and as much as the FCA. This is now a front and centre issue. So after that we have in May, we have the ABI and BIBA have got together with their members and they have come up with principles and action points. For those who are interested in those principles and action points, I'm sure that those who are BIBA members or ABI members, they are actually the last slide. They're in an Icsr. I'm not going to go through them, but they're there if you want to look at them. One of the things that these principles did say was that BIBA and the ABI would do a review and come back with a report within 2 years. That's somewhat been overtaken by events. We have October, the FCA finally issued their thematic review. And there are a number of points here which are quite important. The first thing is that they did find that differential pricing existed and that there were some customers who were paying considerably more than other customers. I don't think that's going to be too much of a surprise. There was also a finding that there was a risk of customer discrimination. So what I'm going to concentrate on, though, is the ineffective governance point. Now, this was a finding in the thematic review. And what they found was that for pricing, there was no pricing strategy. If there was any discussion, it was during annual planning process. And that was it. So there is no, for most insurers, for possibly MGAs as well, who are involved in pricing their products, there was no strategy around pricing. They also discovered or identified that there was a complete lack of communication between the annual planning process and the pricing, or the people who were pricing the products. And pricing itself tended to be a focus on what was required. So if there were pricing increases or decreases, it was what was required to meet annual plan. The consequence of that, and a direct consequence, was that there was almost no focus on the impact of pricing changes to customers. And the FCA have identified that that itself gives rise to TCF questions. Treating customers fairly, for anybody who doesn't know what TCF means, but I'm sure that's not the case here. So not only was there an issue around TCF questions on pricing, but they also identified that when pricing was taking place, when decisions about pricing were taking place, it was, and quote this, far removed from the board and the executive committees. So the board and executive committees have looked at annual plan. That's been given to individuals involved within the business and the executives. They've pushed it down further to the people who've actually undertaken the pricing, and that's it. Board has never seen anything further. So there is no, and they have said no, first or second line oversight of pricing in businesses. I think that's a little surprising. I don't think, my own experience is that that's probably not necessarily the case, but we will come back to that when we look at what the FCA could do about it. And here's a warning for everybody. Those of you at MGAs are facing SMCR this year. One of the things they made a point about was that there was no evidence of any allocation of responsibility for pricing. And I think that will come back to haunt a few of the insurers who are already supposedly SMCR compliant. Pricing seems to have just been looked at as, well, we know what the plan is, this is what we have to do, this is the pricing that we're going to go through with, and there has been no real governance around that from on high and no oversight of that. So that's October. Also in October, the FCA has issued a discussion paper and they've issued proposed terms of a market review, a market study. Very, very closely associated to that is the Citizens Advice Super Complaint. So everybody, thought the super complaint was really the beginning of this. It's been going on for quite some time, but it's being ratcheted up every time. The rhetoric is getting greater, and there's greater focus on what needs to be done. So the super complaint comes out, and it's not just, interestingly, we talked earlier about groceries. It's not just about general insurance. It's about mobile, broadband, cash savings and mortgages. Now, in the cash savings world and the mortgages world, the FCA are more advanced. They have already started looking at, dare I say it, pricing regulation. And that is certainly not what you want to see in the general insurance industry. We then have, after October, the CMA have been brought into this. Obviously, it was a super complaint to the CMA. And in December, the CMA issued its response. They recognise that it affects many people. They recognise that not enough has been historically done to deal with the issue. And here they are almost parroting the government green paper. So all of this is heading in one direction. They say that there's a strong case to consider price controls. Now, I truly hope that that is a discussion about mobile phones or cash savings or mortgages, because it seems to me that the whole regulatory environment in this country has been about principle-based regulation. You want pricing regulation, you can go to the US or you can go to other countries, but that's not the way it's supposed to work here. And yet, that's the discussion at the moment. So, we have that, and they issue 8 key recommendations. Number 1 on their list is bolder use of enforcement powers. That's starting to sound a little worrisome. Publication of loyalty penalties. And I emphasise the word penalties because that is the word that they have used, penalties. What is the publication of a loyalty penalty? What that would mean is when you receive your quote for your renewal on your household or your car, it will say, or should say if this comes to being, this is what you are paying, or this is what we are quoting you, and if you were a new customer, this is what you would be paying. In government terms, in behavioural economics, that would be a nudge. Next on their list of recommendations is pricing regulation. Pops up again. And finally, there are 8, but I'm only dealing with the top 4. The final one that I'm going to mention is the market study. And we already know in December that the FCA is undertaking a market study because they've issued their draft terms of reference. So shortly after the CMA have come out with all of that, the FCA comes out with a very short statement on its website. We agree. They've had their thematic review. They've identified that there are issues to be dealt with. And they're agreeing with everything the CMA is saying. Pricing differentiation. What does it actually mean? Well, the first thing we should recognise when we talk about pricing differential, it's the practice of varying prices charged for an equivalent product to different customers with the same or very similar risk characteristics. Per se, by itself, not an issue. We know, you know, that there are very good examples of where that's acceptable. Cheap prices for students. Airline tickets which get expensive the less there are in a plane. Same product, generally the same customers, some differentiation. For valid reasons, for fair reasons. And the FCA has recognised that that sort of thing is fair. What they're concerned about is where it's not fair. And there are 2 areas that seem to come up here. One is the loyalty pricing, which is a customer who stays with an insurer for a long time, or a provider for a long time, their price seems to steadily go up. New customers get it cheaper. The other one is discrimination. And that's based on price sensitivity. And we'll look at each of those. Loyal customers. This is about the simple fact that there are automatic renewals. It's always been the case. Perhaps not 300 years ago when we were in this building, but for many, many years, automatic renewals have been the case. A number of policies, many policies in fact, have automatic increase prices. I'll come to my household insurance shortly. Not that I'm mad about it, but it's a very good example. And the issue, if you think about this, everybody knows that it is harder to get a new customer. It costs more to get a new customer than to keep one. So actually, if you're a loyal customer, perhaps your price should be going down because it's costing less for them. The cost base for an insurer or for an MGA is less because it's an automatic renewal. But what's happening is the price is going up each year for loyal customers, and new customers are getting it cheaper. And my own example is a very good example. I've been with the same insurer for about 12 or 15 years. I can't work it out. I haven't bothered to go back and have a look. My household insurance has gone up to 2.5% every year. When all of this started happening last year, I got my next door neighbour to get a quote from my same insurer. Now we have, what's it called? A semi-detached house. So he has pretty much the same house as me. We're in the same neighbourhood, same postcode, all that sort of thing. His quote was almost a third of mine. What message is that sending to consumers, to the public? Now, it's about fairness. I chose the insurer because they're a very good insurer. I chose them because my house is one of my main assets. If it falls down, blows up, whatever could happen to it, I want to know that I'm secure. I didn't quite expect to be paying that much for security though. I also have a friend over Christmas. We had friends over for Christmas. I said, what do you think about this? He says, yeah, I've heard about this. Last year, his mother, aged mother, her renewal came up. He thought, it's actually quite high. So he got an alternative quote. He then rang the insurer that his mother was with and said, I've got this alternative quote. It's almost half the cost of your quote. Why is my mother's quote going up? And they said, oh, don't worry about that, but we will underwrite your mother's policy for the same price as that quote. And all of a sudden you think, how can they do that? Why weren't they just offering me the best quote in the first place? We are sending, as an industry, a message to consumers that is mixed. So, what else is happening? Loyal customers are paying more than new customers. The FCA has identified quite a significant issue with that. Loyal customers are essentially subsidising the growth of insurance companies. Because an insurance company or an MGA which wants to grow is going to try and attract customers, so they're going to give them an offer. And through crunching the numbers, they've identified that the insurance companies are only making money out of the loyal customers. Not in every case, but there are a fair few cases. So that is a subsidisation. Now the issue with that may seem not entirely unacceptable, but the issue is, from a competition point of view, if you are a new entrant into the household market, the motor market, travel market, the pet market, whatever it may be, and you don't have a customer base, then you have an issue. You cannot get in because you can't compete with other companies that have a customer base, because that other customer base is paying for them to be able to grow and for them to keep you out of the market. So all of a sudden we're in a competition issue, which is why the CMA is involved. The subsidisation of new customers by loyal customers means that new entrants find it hard to break into the market. Okay, price discrimination. So the FOS complaint report identified a series of different complaints which were increasing around pricing. And the complaints were about gender, email address. You must have seen some of the stuff about email address. Pricing according to whether you're on Outlook or Gmail or extraordinary. I can't understand what the difference in risk is, but some insurers believe there is one. Ethnicity, and postcode. So the FCA say, well, let's have a look at that as a part of our thematic review. Postcodes. And the questions they have posed are interesting. Is the difference in postcode and the different pricing in postcode due to an actuarial assessment of the actual risk? So is there a difference because the risk is different? Or is it because the insurers are looking at the different postcodes and saying, well, those people over there, that's a wealthier suburb, they can pay more? Is it because of price sensitivity? This group of people in this area are less likely to move their product than this group over here. And that is where the data piece comes in. This is one of the first real examples of the FCA looking at big data and looking at the way that people are using it. And they're concerned. Oh, sorry, I should just mention one other thing. The FCA have already said that if you are pricing according to gender or ethnicity, then they're going to cite the Equality Act at you. So they've lined that one up already. Anyway, let's go back to big data. The question that they've now posed themselves is big data being misused? Are insurers and others using data to identify customers who will be prepared to pay more? Loyal customers, customers in wealthy areas, customers who have the ability to pay more or are less likely to move, because that's pricing discrimination, and that will end up back where we've already been talking about. The other point that they've mentioned is that they're concerned, and they have identified that when they look at the way that insurers are treating data and data about their customer bases, is that they're, or data that they are buying or obtaining from third parties, is that there is no evidence, they have said, of any review of that data to see whether or not the data itself is already biased. So it's quite possible that insurers aren't misusing, if we want to use that expression, data, but it's quite possible that the data sets themselves are already biased, and that could lead to a just discrimination in any event. So that's where we are. The rules, and this is not a list of the rules that I have come up with. This is the list of the rules that the FCA have cited that they will use if they need to. Everybody knows treating customers fairly. Please tell me if you don't. But we all know that that's going to be used here somewhere. It's a principle, it'll get used. We also now have the new product governance rules, PROD. And the one there that I think speaks the loudest is products must deliver appropriate client outcomes. It has a direct link back to treating your customers fairly, because that's an outcome. That's one of the key outcomes. So the question for everybody on this is, under the product rules, how and who is responsible for delivering those proper client outcomes? Under PROD, it's the manufacturer of the product. So that's a question of fact, not a question of agreement, a question of fact. Are you comfortable that you are or are not the manufacturer? Are you the co-manufacturer of a product? Have you got an agreement about who is responsible for what in relation to the manufacture of that product? Most importantly, if you are a co-manufacturer, what governance have you got? Because the FCA have already identified what they expect governance around pricing to be, and that is based on what they have seen doesn't exist and what they think is appropriate governance for pricing. So MGAs need to think about that. If you're a co-manufacturer, have you identified who's responsible for pricing and what governance have you got around it? Okay, so ICOBs. Even if you aren't a manufacturer, the ICOBs rules now have 2.5.1 RA. We've all heard about this, best interests rule. It's new. It came in under the IDD on the 1st of October, and it applies regardless of prod. Okay, regardless of the product rules, it applies. Everybody has to work in the best interests of their customers. So even if you're not the manufacturer, if you are somehow involved in a process which identifies loyal customers and charges them more, you really need to be thinking about this, because I don't think my insurer, and I don't use an MGA or a broker, but I don't think that I am being treated fairly. And I don't think the insurer is acting in my best interests when he's charging me 3 times what he's charging my neighbour. Even though I stuck with that insurer because I believe that they provided great protection, I am a loyal customer for that reason. All right, and then COCON. Individual rules. These are SMCR. And as I've said, the FCA has already identified the lack of allocation of responsibility. So you guys have got till December, the MGAs have got until December to be thinking about how COCON will apply. In an MGA, somebody, generally, is identified on a binding authority as the person primarily responsible for that binding authority. How are we going for time? Good. That person may or may not be subject to the COCON. And even if they aren't, management will be. And management are expected to make sure that they are complying. And management are expected to make sure that they're controlling their business effectively and that they're complying with the regulatory system. Okay, so what's next? Again, a list from the FCA. This is in their thematic review paper. The first thing they say is that they are going to use their supervisory powers. The government have said it. CMA have said it. The FCA have said it. Now the reason that they've got that as the first of their lists is because they've already identified that there are firms who are failing. In their thematic review, they've been to see some firms, they've done some work, and they've identified firms that are not complying with their requirements. So number one, we're going to have a chat with them. And I've always identified the last one, who would discuss with individual firms the issues identified. That to me is the most famous euphemism. It means that they're going to use their size 10s. But also in this case, they will be coming around seeing firms and talking about what they're doing, because they haven't finished. They've got a market review coming up. They haven't finished working out what they're going to do, because the thematic review has identified some concerns for them. It's identified some firms that aren't doing what they should be, but they're not finished with this. You know, there are probably some very valid reasons why there is pricing differentiation, and they want to get a much better understanding of what that might be. So number one, they're going to do that. Number two, they've given everybody the hint. Take immediate steps where necessary to address the issues. So they've issued their thematic review. They've said what they've found. They've said what their concerns are. They want firms to be acting now. They don't want to be turning up and saying, what have you done? And you say, oh, that's not really going to help them very much. They are going to talk to the trade bodies. They're going to engage with consumer groups. They're going to have public debates. They've issued a document, a discussion paper, which is a good read. Sorry, I shouldn't say that. It does help clarify what the issues are and what their concerns are. So if this is an issue that you really need to think about, and clearly a number of you are here for that purpose, grab the discussion paper. And then they're going to undertake the market study. And they're going to look at those 4 things. And the first one, harm. They want to look at scale. The ABI has issued a document that identifies that 75% of customers swap their household insurance every year. So really we're talking about 25%. Me. And clearly some other people. But they want to understand how harmful it is, how big the scale is, and they're going to be looking at vulnerable customers. Now that is a theme that is probably for another day, but they want to know that firms are identifying potentially vulnerable customers and are doing extra work for them. Fairness. They're going to look at, are the products essential or non-essential services? Remember, this is a review of more than just general insurance. So in the general insurance world, I would say that motor was an essential. I personally think household is an essential as well, but not everybody has household. So they're going to look at that. They're going to look at the idea of auto-renewal and clauses, not just increase average annual increases in prices, but clauses which can result in a greater price or a tie-in. So there are products that make it difficult to change. If you have one of those, you have a way of tying your customers into you so that they become loyal customers. Think about that. And a part of fairness is all about transparency. So they'll be looking at how you are providing information to your customers about your pricing and your pricing policy. And the impact of the pricing practices on competition, that's a subsidisation. So they're going to come back to this loyal customers and keep coming back to it. And they're going to look at potential remedies. So these are what they've identified as potential remedies. Well, actually the first one, no change. Oh, I put that in. I think the likelihood of that is minuscule. I think there will be something. I don't think that we're all going to like it. I think that hopefully the trade bodies like the MGAA will be able to have discussions with the FCA and get to an area of reasonable acceptance that work needs to be done and that it can be done. Changes to pricing practices, pricing regulation. That's really not where we want to be. Contractual languages, the auto-renewals, pricing and structure restrictions. I think that's a place that they may look at. I think that that's one that is probably easier to deal with than some of the others and would be easier to live with than some of the others. Limits on pricing differences. It sounds to me like something you might find in savings or mortgages rather than general insurance, but I can't guarantee that. Further transparency, discrimination bans and the like. All of that mirrors the CMA report. So there's an awful lot of alignment here. It mirrors what the government green paper came out with. Right, now for the most important part, I think, what you can do now. Because these things can take time. Last year was a very busy year in this topic, but these things can take time before they roll out to the eventual conclusions. The first thing I think everybody needs to do is look at what controls you have on pricing at the moment. Do you have an underwriting policy? What does it say? Who's responsible? How does it roll in with your TCF or conduct risk policies? Who is the owner of your pricing approach? Is it the board? Is it your product governance committee? Because I'm sure you all have product governance committees by now. Is there an individual? MGAs, binding authorities, individual responsible for the binder. You could see that they're a little bit like having a target on their back at the moment. Sorry for any of you here. Product governance approach. Do you have MI on pricing as opposed to other aspects of the product? How are you reviewing your pricing approach? Because the product governance committee really is the right place to be, I think. It's a good place to have it. And the product governance committee should be reporting to the board or the executive committee, so you're getting it, you're getting that sort of increase. It's going up. It's being escalated to the right levels that the FCA want it to be escalated to. And then first and second lines of defence. What's going on there? When was the last time compliance did a review of any sort, an audit on pricing policy, pricing governance, or just how it's operating? So start with governance and then look at your books of business. Do you actually have any books of business where this could be an issue? And you'll see at the bottom that at the moment we're just talking about household and motor, but the FCA have made it clear that they're going to roll it out to pet, travel, health, maybe. There are some issues around health that make it slightly different, but I believe that simple health products where you're providing a daily benefit for somebody who's off sick is also open to this sort of issue. So are there any differential pricings? If so, what's your basis for it? How do you justify it? What data have you been using? Because remember, there is this data element that they are going to drill down into. Does the pricing approach result in fairness? Okay. And then customer surveys. Great, absolutely fantastic tool. Why has a customer stayed with you? If I got a survey from my insurer, I'd have to say it's because I trust that insurer to pay my claim. So is it therefore unfair that I should, be paying 3 times what my neighbour could get the policy for? I've stuck with them. That's a good question. I don't know. But these are the things that you could be doing. Are there any other mechanisms? No claims discounts. Big in motor, never heard of it in property. Never heard of it in household. I haven't had a claim on my policy, funnily enough, until October last year. But 12 to 15 years, and all that happened was my policy went up. I don't think the risk changed, but why was there no claims discount? Greater transparency. Always welcome in the FCA world. What do you tell your customers? How do you tell your customers? And then you could undertake regular business book reviews. Now that was actually one of the outcomes from the ABI and BIBA principles, is that if any members had a book of business that was more than 5 years old, then they would review it. Now I know that there hasn't been any review of my insurance, and I know that my insurer is an ABI member. So maybe because there was this two-year plan to come back with a review, the expectation was that they'd be able to deal with it in the 2-year period. But that has been overtaken by events. So those are some of the things. And then importantly, the FCA is going to talk to market associations. So engage with your market association. Engage with Peter. Keep him busy. Please, keep Peter busy. Okay? IUA, MGAA, LIBA, BIBA, LMA. Go and talk to them because they're all engaged in this. They all know that this is there and they're all there to try and help. Okay. Questions?
Hello there. Surely the longer you stay with an insurer, the greater the risk is of them having to pay a claim out. Therefore, the risk of a loyal customer goes up, not down. And also, is it not the case that prices are generally set based on the entire risk for the insurance company, not on any one individual? So they're looking at motor claims, there are higher motor claims happening, therefore the whole industry gets more expensive.
I think there's an argument in that. I mean, there are lots of arguments about this. The argument in my case, and I use my example, the argument in my example is that the cost of reparation to my house has gone up in line with CPI. But I recently changed the boiler in my house, and I paid the same amount for that new boiler as I paid for my last boiler 12 years ago. And I have had building works done over the 12 years, and roughly I'm paying about the same for my builder now as I did then. So I understand the argument that CPI has gone up, but I don't see that actually the cost of providing me with the service that I might need has gone up over that period. So you're right about the level of risk. It may or may not increase. Obviously, it's about looking at the pool of risks. I think this is not necessarily about that, though. I think that this is about how insurers and brokers have actually used the information they have to identify those who may or may not change. And that's the underlying piece here. It's that 25% of people who haven't changed. How many of those are vulnerable? Why have those who haven't changed not changed?
To me, it would be the same argument as why petrol prices in motorway service stations are more expensive. Because they can be, because they can exploit that opportunity.
Yeah. So
why would the FCA think that small section is okay for exploitation, but other financial services maybe aren't?
I don't disagree with you. I think, this is all a market, right? But having undertaken their review, their look at the market, they have identified that that's not the way it's working, right? The book of business, the book of household business that my insurer has, they're not saying, right, this is the price that we should charge for a 4-bedroom house in this suburb. They're not saying that. They're saying, we're just going to add to your price every year. And it will keep on going. And that's the issue, and this may be one of the solutions. Maybe one of the solutions is to say, right, this year our cost of capital, because it's easier now to find out what your cost of capital is because of Solvency II. And frankly, we all know cost of capital has come down. So underlying costs of dealing with loyal customers has come down because you're not having to gain them as a new customer. So the underlying base cost of that customer has come down. The capital cost has come down. And yet the price is going up.
Yeah, it just seems like what we're about to do is to say, let's put 1% on everybody's policy every year, and then we're completely fine.
Well, that may be it. Or what you do is you have a different way of actuarially analysing. God,
well done on that one.
Analysing the book of business and saying, okay, we expect to have this number of houses in these regions. This is the totality of what we expect the losses will be. This is the totality of what our costs should be. And yes, we should be able to make a profit, so we should be able to add this. Therefore, the price should be as follows. And that's so everybody is individually priced annually. Increase in price.
Kenneth, thank you for that. It's very interesting because in your slide you talked about the governance over pricing. Now, it's great to have protocols and the policy that we would adhere to, as long as we adhere to it and don't stick it on the shelf and forget it, because we've seen a few claims come around that way. So John's point was well made. So if we then turned around and said, right, this is why this class is having that increase, because of, and we justify that, it may not sit across the board with other intermediaries, let's say. But do you think that that would be valid if we turn around and say yes? And that, earlier on you talked about postcodes and the bias on postcodes, and then we all know that the post office set the postcode. And there have been situations where the post office did decide that a particular village needed to have their post early in the morning, so gave you another postcode that linked to the local town that had perhaps one of the worst situations of burglaries. And literally overnight, everybody's rates tripled because they put it in. Now, how do you say to the regulator, hang on a minute, the postcode is not biased. I don't set it. We're trying to work it.
But
so
that's
it goes back to your situation.
Being biased, yeah.
Yeah, but it goes back to your situation that if we have this protocol, we have this policy, and we look at it, and John's point well made, we actually go in there and we can justify why these rates are going to be there.
And I think that's the point, is look at your books of business and work out what, if you have differentiation, what is the justification for it? Is there a valid justification? Because if there's a justification and it's valid and customers aren't being unfairly treated because the justification is valid, then you should be okay, right?
Any more questions from the floor? Yes, Marco.
Hi. Most of the focus here has been on UK personal lines.
Yep.
Question for you. Is there going to be any focus outside of UK personal lines as in wholesale, SME? And then for those of us that happen to be dealing in Europe, is there any other movement from any other regulators of equivalent stature, if you will, that are also looking at the same thing in Europe?
Okay, so I was hoping that the question of SME would come up. Thank you very much. Not planted, but often what happens in personal lines moves into SME, right? I don't see that being their focus at the moment. There is certainly movement towards smaller end SMEs being treated like consumers, as we know. So you could see possibly that this will spill out into some of the SME lines of business, yes. If the same traits exist, then there is no reason for the FCA not to consider looking at that. But they've got an awful lot of work on their hands at the moment, and this is one of the few agendas that they are pushing outside of Brexit. So there's an awful lot for them to do as it is, and if it does happen, it won't be this year. I wouldn't have thought, but it is a possibility. Europe, I'm not aware of any similar issues going on in Europe.
Any more from the floor? Let me throw one at you, if I may, Kenneth. You mentioned earlier on about maybe when we do our documentation to our policyholders, our clients, we have to say, well, if you were a new client, you'll be charged X. Mm-hmm. As you're an existing client, you charge X plus 30%. And by the way, last year you paid X plus 25%. Yeah. Are we actually going to see 3 sets of numbers in that renewal document? And will that not itself create even further confusion?
I would be horrified if we ended up there. I'm truly hoping that if that sort of thing happens, it'll be mobile phones, money savings and mortgages, because it's more appropriate, I think, certainly in the savings account world. I can't see that being healthy, and if it was heading in that direction, I really believe that the industry itself would recognise how unhelpful that would be for the industry as a whole and would deal with it. So I don't think that's what would happen, but that's what is being suggested could happen across the board. We've all, I think, in recent years known that the FCA works on behavioural economics and nudge theories, and transparency is all about nudging people to help themselves, like me, and that would be, a nuclear option nudge for everybody to receive. You are paying more because you have been with us for 5 years or 10 years. That would send everybody off buying a new policy. And that would not be helpful for this industry, because all of a sudden, instead of having 75% changing every year, you might have 95%. And that's just going to cost the industry more money. And then actuarially assessing what your book of business is going to look like every year is going to be even more difficult, because there is no guarantee around any of it. So I really believe that that's not the place to be, and hopefully not where we end up.
Any more questions? One, you have to shout, sir, please, if you will.
Yeah, I'll shout. David, it seems to me like a lot of the price differential comes from discretionary discounts that brokers have. As the FCA said they're going to look into that, because as you rightly pointed out, an example, if you ring someone up, they'll often give you 10% off. That almost feels more unfair for such a new business.
I think the answer is that they're going to look at all aspects of how pricing is dealt with. And that's a very good example. For me, an MGA is given discretion around its pricing. You can price between X and Y. So the interesting thing about that is that pricing is then moved from a decision of the underwriter, the insurer, to a decision of the MGA. And the question really then becomes, how are you governing the use of that? Is that fair? That's all they're looking at is that fair? So if you have a reason why that should be fair. If you have bands and things within which a risk can be priced, then I think that there may be a justification for that, provided that it's not meaning that the loyal customers are not being treated fairly. And it's I don't think that there is a solution for that. I don't like the idea that there would not be that discretion. There should be an opportunity for an MGA or an insurer to say, actually, okay, we gave you a quote. It was based on a fair assessment of your risk, but we recognise that there is somebody else out in the market who is charging less. Now, that gives you the opportunity to say, that's healthy competition, and we'll let you go. Or, actually, we think you're priced at Y, but we will charge you X in line with what they're doing. And it happens every day, right in this building. So you have syndicates here on large risks putting out a quote at, say, $1 million for an offshore oil rig, maybe 10 million. And then another broker comes into a different underwriter and gets a different quote. That client, that oil company, will go back to the first one and say, we've been with you for 10 years and you're charging us 10 million for this, and we've got a quote for 9 there. Are you going to match it or not? Right? And that happens on a big scale. So there should be capability for that to happen on a small scale as well. But it's all about making sure that the original pricing is fair and that there is some governance and control around it. So, going back to that justification, what is your justification for doing that? Competition. Yes, okay, we recognise that keeping this customer is going to cost us less than finding one to replace him. Okay, we'll cut it by 10%. We'll match the price.
Thank you. Any more questions? Okay, we'll call this session to a close. Ladies and gentlemen, would you please thank Kenneth for an excellent presentation.